What if I told you that with just $500, you could start earning passive income every single month, without picking individual stocks, stressing about the market, or waiting years to see results? That's right, today I'm showing you exactly how to invest $500 into 5 dividend-paying ETFs, both Canadian and US, that pay you every month. Before we dive in, make sure to smash that like button, subscribe, and drop a comment below. Also, can we please hype this video up? Alright investors, let's break this down. Dividend ETFs are one of the easiest ways to start earning passive income, even with a small amount of money. Instead of buying individual dividend stocks, ETFs let you own a basket of companies that pay dividends regularly. That means you're instantly diversified, and you can collect consistent income every single month. And the best part? You don't need thousands of dollars to start. I'll show you how to spread just $500 across 5 powerful ETFs that pay monthly dividends, giving you income potential right from month 1. First up, VDY2, Vanguard's FTSE Canadian High Dividend Yield ETF. Objective: deliver steady income from Canada's top dividend payers. Ticker: VDY2, dividend yield around 4.8%, distribution monthly. MER: just 0.22%. Nice and low. VDY tracks Canadian high dividend stocks. Think big, reliable names like the major banks, pipelines, and telecoms that have paid shareholders for decades. If you're a Canadian investor seeking steady, reliable monthly income, VDY is a strong core building block. Quick snapshot of what it holds. It tracks the FTSE Canada High Dividend Yield Index, a rules-based basket of established dividend payers across the TSX. Sector breakdown roughly. Financials lead, followed by energy, then telecom, giving you exposure to Canada's dividend heavyweights. Top holdings typically include the big 5 banks, major pipelines, and national telecoms, reliable cash generators with long dividend histories. Payout cadence: monthly. Historically, the yield has floated in a moderate range, rising when prices dip and easing when prices climb. Income is the focus. Fees matter. With a 0.22% MER, more of your dividend stays in your pocket compared to higher cost funds. Small percentages can compound big over time. Key risks: sector concentration in banks and energy, sensitivity to interest rate moves, and the chance of dividend cuts during downturns. Who it's for: Canadians wanting diversified exposure to blue-chip dividend payers with simple, steady monthly income potential. Example time. Purely illustrative. If you put $100 into VDY at a 4.8% annual yield, that's about $4.80 per year, or roughly 0.40 per month before taxes. Depending on price, that might be a small fraction of a unit, but the key is consistency and reinvestment to grow your income over time. Tax note: high level. Eligible Canadian dividends may get favorable treatment in taxable accounts, while RRSPs and TFSAs can shelter or defer taxes. Always check your situation. Bottom line, VDY offers low-cost monthly income from Canada's dividend leaders. A solid foundation for passive income seekers. Up next, ETF number 2, Endosser XEI2. Next up, XE2, a broad Canadian high-dividend ETF built for steady monthly income. Objective and method: XEI targets Canadian companies with high, sustainable dividends across major sectors. It pays monthly with a yield around 5% and keeps costs low with a 0.22% MER. Versus VDY, XEI is broader and less concentrated. You still get financials and energy, but also more telecom and utilities exposure, which is why it pairs well with VDY. Approximate top exposures include telecoms like BCE and TELUS, pipelines like Enbridge and TC Energy, and the big banks such as Royal Bank and TD, dividend mainstays in Canada. Why it complements VDY: combining the two reduces single-sector concentration and can smooth income while keeping the focus on high-quality payers. Key risks: a value tilt, sensitivity to commodities through energy exposure, and the chance that some dividends get cut during downturns. Diversification helps, but it doesn't eliminate risk. Who is XEI for? Investors prioritizing stability and dependable income from Canadian blue chips with a simple, low-cost approach. Quick illustration: put $100 into XEI. At roughly 5%, that's about $5 a year. close to 42 cents per month on average, before taxes and fees. Distributions vary and aren't guaranteed. Account tip: many Canadians hold dividend ETFs in registered accounts like TFSA or RRSP to improve tax efficiency. In taxable accounts, consider how dividends are taxed and your personal situation. Bottom line, XEI adds broad, monthly Canadian income at a low cost, a solid partner to VDY. Now, let's cross to the US for one of my favorites. Now let's cross the border to the US with one of my personal favorites, SCHD, the Schwab US Dividend Equity ETF. Quick stats: yield around 3.5%, distributions are quarterly and dependable, and the MER is just 0.06%, ultra-low costs that help more of your dividends stay in your pocket. Strategy-wise, SCHD tracks a quality-tilted dividend index. It screens for profitability, consistency, and dividend sustainability. Think strong cash flow, solid balance sheets, and reliable payout histories. You'll see a tilt toward consumer staples and industrials, mature cash-generative businesses, plus tech-light dividend names. It's built for durable income, not chasing the hottest trends. Historically, SCHD has delivered steady total returns with less drama than the overall market. No guarantees, of course, which makes it a favorite for long-term compounding. That rock-bottom 0.06% MER matters. Fees stack up over years. Lower costs mean more of your dividends and growth compound for you, not your fund provider. Risks: sector tilts can underperform at times, dividend growth can slow during recessions, and like any equity fund, prices will fluctuate. Canadian investors, remember FX. SCHD is in US dollars, so currency moves can help or hurt returns when converted back to CAD. Example time: put $100 into SCHD. At over 3.5% yield, you're looking at roughly $350 per year, paid in 4 quarterly checks. Reinvest those payouts and the snowball gets bigger. Quick tax note for Canadians: US dividends face withholding taxes. RRSPs are generally exempt under the treaty. TFSAs are not. In taxable accounts, you may claim a foreign tax credit. Always confirm for your situation. Bottom line, SCHD is a core US dividend growth building block. Quality, consistent, cost-efficient. Pair it with monthly payers like VDY, XEI, JEPI, and SDIV to smooth your cash flow while you compound. Coming in at number 4, JEPI, the JP Morgan Equity Premium Income ETF. Think S&P 500 stocks, plus an income engine layered on top. Strategy in plain English: JEPI holds high-quality US large caps for core market exposure, then writes covered calls via equity-linked notes to generate extra cash flow. Covered calls mean JEPI sells option contracts on part of its holdings. In return, it collects option premiums, paid out to you as income. Yield typically lands around 7 to 9%, with monthly distributions. It fluctuates because option income rises and falls with market volatility. JEPI is actively managed. The MER is 0.35%, higher than plain index funds, but you're paying for the options overlay and active selection. The trade-off: more income today, but some upside may be capped during strong rallies because calls can trim gains if stocks surge. Key risks: option strategy risk, ELN counterparty exposure, and normal market drawdowns still apply. Income doesn't eliminate stock risk. Who it's for: income seekers prioritizing steady cash flow over maximum growth, retirees, bridge income investors, or anyone who values monthly payouts. Quick $100 illustration: at an 8% annual yield, that's about 0.67 per month, purely illustrative, not guaranteed. Tax note: option-related income can have different tax treatment than qualified dividends. Check your account type and local tax rules. Bottom line, JEPI can be a powerful income tool, but diversify, size it sensibly, and don't chase yield in isolation. Up next, a higher-risk option, SDIV. And finally, our global high-yield pick, SDIV. Think of it as a worldwide basket of dividend payers focused on income. Quick stats: yield around 11%, monthly distributions, and a management fee near 0.58%. Strategy-wise, SDIV targets high-yield equities across countries and sectors, broad diversification, but concentrated on income first. Higher yield often signals higher risk. Many holdings are there because prices fell or payouts are stretched. Classic dividend trap territory. Historically, SDIV has shown meaningful volatility and deep drawdowns compared to core dividend funds. The ride can be bumpy. Costs matter. A 0.58% MER is higher than many broad ETFs. So, weigh that fee against the income you expect to collect. Risks to watch: dividend traps, emerging market exposure, currency swings, and potential dividend cuts when companies get squeezed. Illustrative math: $100 in SDIZ might throw off a few bucks per month, but payouts vary and can change. Treat that yield as variable, not guaranteed. Where can it fit? As a satellite position to boost income, not a core holding, suitable for risk-tolerant investors who understand volatility. Pair STIV with steadier dividend ETFs for balance. Diversification across Canada, the US, and global names helps smooth the ride. Coming up, I'll show you a simple way to split $500 across these ETFs, so you can start collecting income as soon as month 1. So here's how you could invest your $500, $100 in VDY, to $100 in XEI, to $100 in SCHD, $100 in JEPI, $100 in SDIV. That's 5 dividend-paying ETFs giving you exposure to Canada, the US, and global markets, all paying you income each month, or close to it. And as you reinvest those dividends, your passive income snowballs over time. That's the power of compounding. Remember, you don't need a fortune to start investing. The key is to start now. $500 might not seem like much, but it's your first step toward financial freedom and passive income that grows while you sleep. If you got value from this video, hit that like button, subscribe for more investing breakdowns, and comment below which of these ETFs you're buying first. This is the Piggy Bank Chronicles, where we help you grow your money one smart investment at a time. Thanks for watching, and I'll see you in the next one. Peace.